Let me ask you a question. What has been the single most frustrating part of being a precious metals investor over the last, say, decade? You know the answer. It's watching the price of gold and silver finally start to move, getting excited, looking over at your mining stocks, and seeing them do absolutely nothing. Or worse, go down. It's been a story of pure gut-wrenching disappointment for years. Well, I'm here to tell you that this painful dynamic isn't just ending. The data shows it has completely, and I mean completely, reversed. Welcome to the Bullion Signal podcast, the channel where we look at the macro trends and hard data to help you protect and grow your wealth. Today, we are diving deep into the Great Reversal.
So let's just get right to the heart of it, right? This is the question that has haunted the entire sector. I mean, why have these stocks, which are supposed to be the high-octane, leveraged way to play a rise in metal prices, consistently failed to deliver on that promise? Understanding this shared frustration, this pain point that so many of us have felt, is absolutely key to grasping the sheer scale of the shift that we are witnessing right now.
And to really appreciate just how powerful this change is, we first have to take a quick look back. We have to understand the old, painful playbook, the one that wrecked so many portfolios and, honestly, had a lot of us questioning our entire strategy in this space.
I love this quote because it just perfectly captures the feeling, doesn't it? The main event, the real star of the show, was the rising price of silver and gold. And the miners, they were just tagging along, dragging their feet, always a few steps behind. You know, that annoying little brother who just can't quite keep up. It was a constant source of underperformance and a huge drag on anyone who owned them.
Now, this is the entire reason we even bother with the miners in the first place. This is the big promise: operating leverage. The idea is actually super simple. Think about it. A mining company has relatively fixed costs, right? They've got the mine, the equipment, the salaries. Those costs don't change much day to day. So if the price of silver goes up by, say, $10 an ounce, that extra $10 should, in theory, drop almost straight to the bottom line. That means their profits and their stock prices should explode higher, much faster than the metal itself. That was always the promise.
So, if the theory was so simple, why wasn't it working? Well, the reasons were almost entirely psychological. Investors were just deeply, deeply scarred from the last brutal bear market in metals. There was zero trust. People just didn't believe the rallies were real. So their first instinct, their muscle memory, was to sell their mining stocks at the slightest hint of trouble, just to lock in a tiny profit before it vanished. This created a vicious cycle of fear-based selling that kept capital huddled in the perceived safety of physical metal, starving the miners of the investment they needed to really take off.
But, and this is the entire reason for this explainer today, that painful era is officially over. We're not guessing here, we're not hoping. The hard data proves, without a shadow of a doubt, that the old rules of leverage are back with an absolute vengeance. And the results? Well, they're nothing short of stunning.
So first, let's set the stage. What's the foundation for this huge shift? It all starts with the fundamentals of silver itself. We are now facing a massive structural supply deficit. And this isn't because of investment demand. It's being driven by relentless and growing industrial demand. We're talking about solar panels, 5G technology, electric vehicles, all things our world is demanding more of. This fundamental imbalance between supply and demand is the rocket fuel for everything else we're about to see.
And here is the direct result of that imbalance. Physical silver, which we can track here using the popular SLV ETF, has had an absolutely monstrous year. We're looking at a 100% year-to-date return. Now, let's be clear. Doubling your money in the physical asset is a fantastic result all on its own. But for our story today, this is just the baseline. This is our starting point. This is the benchmark we need to measure everything else against.
And this, right here, brings us to the million-dollar question. It's the question we've all been asking for years. If the metal itself is up a clean 100%, did the companies that actually pull it out of the ground fall back into their old, frustrating habit of lagging behind? Or did something finally, fundamentally change? And boom, there's your answer. Just look at the sheer scale of the outperformance on this chart. The miners, represented here by SIL, that's an ETF that holds a basket of the big major silver producers, they didn't just keep up with silver. They absolutely blew past it, posting a year-to-date return of 135%. This isn't just a slight edge. This is that classic textbook operating leverage we talked about, finally kicking in with absolute authority.
So let's just pause on that for a second, because this is the crucial point of this entire analysis. The fundamental reason for owning miners is no longer some abstract theory in a textbook. It's reality. It is happening right now in real time. And what this tells us is that investor psychology has made a 180-degree turn. The market has stopped selling the bounces out of fear. Now it's aggressively rewarding these companies for their massive profit potential. The trust is back.
Now, what's really fascinating is that this shift from laggard to leader, it isn't random. It actually follows a very predictable pattern, a kind of roadmap of how capital moves through the precious metal sector during a maturing bull market. So let's break down this classic three-phase flow, because it tells us exactly where we are and where we might be going.
Okay, so it always starts with phase one, the safety phase. This is where cautious, early money flows into the physical metal itself. People are nervous, they just want the hard asset. And frankly, we were stuck in this phase for years. Then, as confidence builds, you enter phase two, the producer phase. That capital gets a little bolder and it moves into the big, established, profitable mining companies, like the ones in that SIL ETF we just looked at. And our last chart proves we have smashed into this phase. Finally, you get to phase three, the speculative phase. This is when a torrent of money, real risk on capital, floods into the high-risk, high-reward junior explorers.
So that leads to the next logical question, right? We've seen the capital move from the physical metal into the major producers. We've confirmed we're in phase two. But what would be the definitive, undeniable signal that this bull market has fully matured? How would we know for sure that capital is now flooding the entire sector all the way down to its riskiest, most speculative corners?
Well, this slide right here, this is the final stunning piece of the puzzle. We already know the major producers in the SIL ETF are up 135%. But now, look at the junior miners represented by the SILJ ETF. Their year-to-date return is a staggering 134%. It's practically identical. The fact that the riskiest, most speculative lottery ticket part of the market is performing just as strongly as the established giants is the ultimate signal. The money has completed its journey. We are officially in phase three.
Okay, let's take a breath. The evidence is pretty overwhelming. The historical laggards, the miners, are now leading the charge. And we know that capital is saturating the entire sector, from the safest producers all the way down to the most speculative explorers. So what does this actually mean for you? Let's build a clear, simple framework for how to think about positioning for this powerful shift.
Really, the approach here boils down to your personal risk tolerance. There's no right or wrong answer. For a more conservative strategy, the SIL ETF gives you that diversified exposure to the big, established producers. Think of these as the fortresses of the industry. But if you have a more aggressive appetite for risk, and you want to tap directly into this final, potentially explosive speculative phase, then the SILJ ETF, which holds the smaller developers and explorers, gives you direct access to the rocket ships of the sector.
But what if you're not really an ETF person? Maybe you prefer picking individual stocks. Well, you don't have to start from scratch. A very effective and smart method is to simply look under the hood of these ETFs. Go to the fund provider's website and they'll list every single company they hold. You can use that professionally curated list as a fantastic starting point for your own research. It allows you to build a personalized portfolio that perfectly matches your own views and risk profile.
And as we start to wrap up, it is absolutely vital that we connect this very specific story about mining stocks to the much larger macro force that's driving this entire thing. This isn't just some short-term trade. A staggering U.S. national debt projected to hit $38 trillion creates a powerful long-term tailwind for all hard assets. The moves we're seeing are a rational response to fundamental economic realities that, frankly, aren't going away anytime soon.
So, to bring it all together, if there is one single thing you take away from our conversation today, let it be this. The sector that was a source of frustration for so long has definitively taken its rightful place as the market leader. And this is so important. The outperforming action of the mining stocks themselves provides the ultimate confirmation that this precious metals bull market is real, that it's maturing correctly, and that it's gaining, not losing, strength.
And that leaves us with one final, very powerful thought to consider. We've seen the capital complete its journey, moving from the safest assets all the way to the most speculative. With money now flooding every single corner of this sector, could this be the signal that the truly explosive, life-changing phase of this bull market is actually only just getting started? That's the question we should all be asking ourselves. Thanks for joining us on the Bullion Signal podcast. If you found this analysis valuable, please do us a favor and hit that like button, subscribe, and share it with someone who needs to hear it. It really helps us get this critical information out to more people. And of course, please remember, the content discussed in this episode is for informational and educational purposes only. It is not and should not be construed as financial or investment advice. You should always conduct your own research and consult with a professional before making any investment decisions. You are solely responsible for the choices you make. We'll see you next time.